Hi, I'm Andy Marcus, the president of the International Photographic Council, part of the United Nations as a NGO, non-governmental organization. And we would love to invite you to our luncheon on October 18th at the United Nations. Our mission at International Photographic Council is peace through photography, the universal language. We would love you to be there. We're going to have Neil Manowich, the president of Sony Electronics, as the keynote speaker, as well as giving out awards to a bunch of worthy photographers and some scholarships as well. You can get more information if you go to ipc-un.org. Look forward to seeing you all.
Welcome to the Dead Pixel Society podcast, the photo imaging industry's leading news source. Here's your host, Gary Peugeot. The Dead Pixel Society podcast is brought to you by Media Clip, Advertech Printing, and IP Labs.
Hello again, and welcome to the Dead Pixel Society podcast. I'm your host, Gary Peugeot, and today we're joined by Chris Miles, who is a financial expert, and he's joining us from Utah today. Hi, Chris. How are you today?
Hey, fantastic, Gary. Glad to be here.
So, Chris, you've got kind of an interesting story. Before we get into the advice you have for our listeners on getting their financial house in order, how is it that you have already retired twice at your age?
Simply put, to retire twice means I had to screw up the first time. That's what it meant. So kind of give you some quick background on me. I actually, money was definitely not a strength for me at all. I was raised by very good, caring parents. My dad was the hard worker, your word is your bond, kind of person. Both my parents were born during World War II. My mom was much more the free spirit. She was the artist. She was the one that, she was trained by the same master painter that Bob Ross was trained by. Right. So same generation era, always want to leave something beautiful on the planet. So when you get someone who says, follow your passions and your dreams, and you get another person that says, have integrity, your word is your bond, you get me, right? You get Generation X. So anyways, I wasn't, but the thing is with money, I wasn't really taught about money.
Mm-hmm, right.
The one thing I was taught was there was never enough of it, right? It was always like, hey, we can't afford this. What do you think? Money grows on trees? I'm not made of money, those kind of things. And even my dad would talk about how work would literally kill him. He's like, I will die working, because he had already had strokes and heart attacks by the time he was in his 40s.
Oh my goodness.
I didn't want that life. And so I wanted something different. So when I went to college, I was planning to become a business consultant, but I thought as I was going through college, I'm one of those people I think that you should have real life experience too, right?
Sure.
So I took a sabbatical from college before I got my bachelor's degree. And I said, I'm going to find some business to do. And the first business that came up was being a financial advisor, not realizing they take anybody off the street that has no criminal record and can pass a test. That's really all you have to do to become a financial advisor. You don't have to be money genius in any way, shape, or form. Well, I did that for several years. I actually stayed dropped out of college. I never went back. So I'm a college dropout. And I was doing that for a while. And after several years, my dad said, well, Chris, when are you going to sit down and talk with me? Now, understand my dad had that Depression era mentality, right? You got to be cheap. You save everything. You pay off that debt. Everything that Dave Ramsey would tell you to do, when you're talking about living on rice and beans. So that was my dad, right? And so I sit down with him, see his finances for the very first time in my life. And as I look at his finances, he said, Chris, I'm 61 years old. When can I retire? I said, Dad, let's just say this. If you want to retire today, you better hope you die in 5 years, because that's how long it's going to be before your money runs out. He said, all right, well, what do I do then? I don't want to, that's not an option I want. So what do I do? And I said, I don't know. You did everything right, because you stuffed your 401k full. You paid off all your debt. He was debt free, including his mortgage, right? You would think he had done the perfect ideal situation that you hear all the financial experts tell you to do today, that guilt you and shame you that you should be doing more, right? And he had done more, and yet it wasn't enough.
Right.
And that really bugged me. And I said, well, okay, there's got to be some other way. And I told him, I said, I don't know what to do for you, because you did everything right. And for weeks, I was kind of in turmoil. And then, of course, when the students ready, the teacher appears. One of my friends, Doug, I had actually trained him to be a financial advisor. He and I had a conversation on the phone. We started having this argument about what's better, stocks or real estate. And he finally stops me. He said, Chris, how many of your clients are actually financially free? Like where they don't worry about money, including running out of money? He got me on that one, because even the retired ones, always worried about running out of money.
Sure.
That's all right. Well, how about this? How many of you guys as financial advisors are financially free, not off the commissions you've been earning, but actually doing these investments?
Mm-hmm.
I said, well, probably none, because the guys have been working here since the late 1970s and they're still here, right?
Right.
Then there's your problem. And it led me down this path to the point where, I started realizing that there's this whole other world of like real estate investing where you can actually do passive investing. You don't have to be an active real estate investor where you're babysitting tenants and things like that. You can be a passive investor by getting your money working harder for you, generating regular, stable, predictable passive income.
Sure.
And as a result of that, I realized I was living a lie. Either I stay in that industry or I leave, and I left. I said, I'm no longer going to be a financial advisor. I'll be a mortgage broker. I'll teach ballroom dancing on the side, and then I'll just do that. And so I did. But later that year, as I started applying these things, I was able to get to the point where I was able to retire myself when I was 28, almost 29 years old. Mm-hmm. And all just by having these income streams coming in, paying for it. And I never thought I'd be there.
Right.
Now, granted, the reason was twice because the recession hit just a few years later, kicked my butt. And I had to dig out of $1 million debt hole to come back and do it again without filing for bankruptcy. So when somebody says, hey, I'm broke, I don't have any money, I was like, well, guess what? I was $1 million broker than you were. And I still was able to come back and do it again by 2016 when I was 39. So yeah, it was a hard decade, or give or take, but it was worth it. And so that's the thing. That's what I'm really teaching people to do today, is really like what I wanted to have for my dad, right? Is to give him his life back, to give him your freedom and get that control back in your life, so that you have these multiple streams of income. So you work because you want to, not because you have to. Because this in the business. I mean, if you work in a business where you're stress-free, like money stress-free, it's amazing how many more people say yes to you.
Right.
It's kind of like when, as a photographer, if you ever notice that when you have a lot of business coming in, people just automatically keep saying yes to you, right? The pressure's off. You don't have that scarcity mentality.
Sure.
People keep coming to you and you keep saying yes. But the times it's hardest to get people say yes is when you don't have any business coming in.
Right.
It's when all of a sudden things dry up, and then you want that one client, and then they're like, well, let me think about it.
Right.
You work like 5 times harder for those clients than you do when you have money. And that's the beautiful thing, is when you work by choice, because it's almost a passion project for you.
Right.
It's a totally different game changer. So the funny thing is, your business will probably grow and expand bigger than it did when you were living just, solely on that income.
So how did it end up for your dad?
Well, he's still alive today, surprisingly. He's just about broken the record for his cardiologist for the number of stents put in arteries, and still alive to this date. It's been a hard life for him, because he really has been trying to stretch out every dollar he can, his Social Security, veterans benefits, because he was in the Vietnam War. I mean, all those things, right? He's been trying to stretch out as much as he can. And it's been a struggle for him. Like he is always worried about, how do I make my money last?
Right.
And that's the hard thing. And we started to kind of get him to real estate, but it was kind of too little too late at that point, and not to mention it's hard to break patterns, when you've spent a whole life being cheap and thinking a certain way, it's hard to break those patterns again.
Sure.
I will say this, we just had a conversation a few months ago. Him and I are actually closer than we've ever been, I think, at this point, and he was talking, I was just mentioning about, I was traveling, to a business conference, and, and then I was like, oh yeah. And then I went with my family, we went here, we went there. And he's like, I don't even understand that life. Like that, the amount of freedom you have, I wish I would have had that.
Yeah.
I was like, I was working hard. I was trying to raise you the best I could. And it's like, yeah, you did a good job. Like that's never in question. But for him, he's like, I wanted that life. And now that he's pretty much bedridden, right? He's in a wheelchair now at this point. He doesn't have that freedom to do it anymore. Like he was always pushing it off, procrastinating as much as he could. I mean, he lived still a good life, but he didn't do a lot of the travel stuff. I mean, we at most went to like Tillamook, to Oregon, we went to the coast, and we'd go fishing or whatever. Like that was like
those are great family memories, though.
Oh yeah, for sure. There's great family memories, but yeah, he never got to do a lot of the things that he still had on his own bucket list, and now he feels like he's really just waiting for the clock to end, stop ticking, and so it's tough for him, and I do feel very blessed that my life is different. I take it for granted a lot of times. I really don't realize that how much freedom that really is, but it's amazing.
So let's kind of segue into what a small business owner should be look like. I mean, we talked before the show about kind of who this audience is, right? So there's kind of, two segments, if you will. There's the older small business owner who's run a camera store or photo store for several years. They may or may not even own their building, which I think a lot of them do, right? They instead of leasing, they're owning their building. But there's also a younger generation coming into the business who are maybe young millennials who has gotten the business. So for someone who's been in the business for a while, and they're trying to maximize their outgo flow, if you will, what are some of the ideas or thoughts you might have for that person who's looking to kind of maximize? Now, again, many of these folks, I know them, they're in their 50s or even 60s, even a couple in their 70s actually, who are kind of has your dad's philosophy, right? They're going to ride this till they die. What are your thoughts there on maybe removing some of those money concerns?
Stay with us. We'll be right back.
A yoga instructor, a business coach, and a pet insurance rep walk into a bar. Now, I'm going to spare you the punchline to that, but all three of them have something in common. They've all sold millions of dollars in services to the U.S. government. The U.S. government buys everything you could think of. I'm Ricky Howard, former procurement officer and host of the DoD Contract Academy podcast. Head on over to the DoD Contract Academy podcast to learn how you could sell products and services to the U.S. government.
First and foremost, and this would still apply to the younger generation too, is in a business, profit is number one.
Sure.
Is how much do you actually can you take home? I hate seeing business owners that have employees that make more money than they do sometimes. Right. Because as a business owner, as a CEO of your company, you should be the highest paid employee. And maybe you already are at this point if you've gotten your business to a nice, lean, mean machine, right? And by the way, when I say focus on profits, I don't mean at the expense of people. Right. Sometimes people have that negative connotation, but that's not the case.
Right.
Profit should be a really a byproduct of the service you've rendered to other people, right?
Sure.
I mean, when you have revenue coming in, money exchange is only because you're providing us something of value that they value more than the money they pay you, right? And that's why they pay you the money. But really focus on that profit, taking home more. Here's the big mistake, and I'll even give this to the younger generation too. The big mistake in business that people have is that they constantly say they quote unquote reinvest in their business.
Right.
And if you're older, you probably have already figured this out at this point because you realized, wait a minute, I just built another rat race, right? I just created a prison. Like maybe I don't have a job per se, but if you're always reinvesting your money in business, you're not really reinvesting. Sometimes what you're doing is just spending money in your business, right? So that's what I mean. That take home money is key. What do you do with that take home money when you get it? Put it to use, put it to better use. And I don't mean into your crappy 401k plans or IRAs, because you could do those things, but the problem is most people think if they're going to do that, either one, they just willy-nilly throw it in some stock market or something like that, or two, they trust some crappy financial advisor who really is just a salesman in a suit. I would know as one of them, and that's dangerous, right? Because just remember, it's like the blind leading the blind. Financial advisors, I know that. I go once a year, I go to a study group. I'm not a financial advisor per se anymore. But I do go to a study group that has like these top financial advisors in their field that usually make at least a few $1 million a year minimum, right? And it's always amazing how after, I'm the one guy that shows up in shorts and t-shirt, kind of like I'm today. You can't see me, but I got my Nike Freak shirt on right now. That's the kind of stuff I wear to a financial advisor meeting with multi-millionaires like myself. And the funny thing is that you talk to those guys, there's always at least one financial advisor will come to me and say, "Hey, Chris, so how do I retire?"
Right.
There's a problem when even the guys that are the most successful in the business don't even know how to retire themselves. Right. Always. So for you, like taking that money and then putting it to use, I call it get lean, get liquid, get out. Get lean means, be profitable in your business, profitable at home, make sure you're not spending every dollar you make. Take something and put it away. Get liquid means get that money away, but don't lock it up. This is the number one problem that people have is that they've locked their money up in prison. You mentioned they might own a building, right? You're always taught lock up your money in equity in the building or lock up money in equity in your house.
Right.
Well, if you can't use it, it does you no good, right? Because that money's just locked away. You actually put it in the bank's hands versus your own hands by doing it that way, in the hopes that someday you'll be debt free, like my dad was, which didn't help him either. So be careful of that. Also when you're locking money up in 401ks and IRAs, you're locking in a place that you're not really the owner. The government is the owner, not you.
Right.
And so you got to be careful of that. So that's why I say get liquid means, can you get your money unlocked out of those prisons? Can you get your money out of those 401k IRA plans? Can you get your money out of those, stock market where you're gambling it away, which I believe the stock market is about to tank big time soon. Also equity in your home or your building. Is there ways to use that? There are ways to get that money out and then use it to generate streams of income, passive income that you don't have to work for. That's what ultimately is the goal, is how do we get those streams of income come in? Because nobody cares about the retirement plan. The only reason people do retirement plans is you hope that it somehow generates some kind of income stream for you later on.
Right.
But here's the problem, is that in traditional retirement planning, if you happen to be fortunate enough to save, say, $1 million in mutual funds or stock market type stuff, right? You save up $1 million. Do you know that they're going to recommend you live on only 3% a year? There used to be a 4% rule. The 4% rule is dead. It's been debunked a long time ago, and there's still idiots out there that teach it. But 3% is all you're supposed to be pulling off. I remember I had a client in California. He had $1 million. He happened to save. He was lucky enough to pull his money out before Y2K and then put it back in. Pull his money out before the Great Recession, put it back in. He happened to be lucky enough to have $1 million. And his financial advisor said, you'll have to live on $30,000 a year. It's like, I live in California. Homeless people can't even live on $30,000 a year. So he came to us, right? And so we started looking at different things like, this is the get out part of the get lean, get liquid, get out. He said, well, how can we get that money out in other places? And so he actually got his money out in like duplexes, that a property manager managed for him. He got his money out in shared ownership in an apartment complex that somebody else operated and controlled. Yeah, he did some oil and gas investments that are more like leasing the land to oil companies and things like that. These alternative things that financial advisors don't know about. And even if they did, they don't want you to know about because they don't make a commission on it, right? That's why you make more money. All these things he's making double-digit returns on. He went from $30,000 a year, what his financial advisor recommended for that $1 million now, to create $130,000 a year for him.
With the same $1 million.
Yeah, from $1 million. Same money, just different use. And that was the thing that awakened me even after I had met with my dad and I was in turmoil, is that when my friend Doug kind of pointed that out, he said, because I trained him to be a financial advisor, but he left to go do real estate investing. We started to see it. He's like, yeah, what if you got paid 1% a month? Now that $100,000 is paying you $1,000 a month, not $3,000 a year. And I thought, that's huge. And I started to open up possibilities in my mind from my little financial advisor brain that I had for those several years as a financial advisor, started to open up and realize it's not about how much you save up and try to accumulate. It's about what that money actually does to generate income. That's what's key and what's most important.
Now, a lot of people like real estate because it doesn't, it usually appreciates in value, where the stock market has its ups and downs. What are some of the possible drawbacks of real estate? Because, neighborhoods change, things change, circumstances change. Right now, for example, if you're in commercial real estate, you're probably struggling because the work from home thing has devastated that. So what are some of the red flags you might look for in looking at that type of the market?
Yeah, usually it's not market. It's more the person that invests in it.
Okay.
That's where most mistakes happen. Because, like, for example, when people think about, I want to do real estate investing, the first thing they think of is buying that property in their backyard, right? In their own neighborhood or their own town or something like that. That could be really risky because, for example, I live in the western half of the United States. Anything in the western half of the United States, I wouldn't buy. It's just not good because prices have come up so much. Rent prices haven't caught up with that.
Right.
So you're really gambling when you try to buy out here. But when I look at buying property, I look at like the Midwest. I look at the Southeast, for example, like in those markets, and not in the hot markets like Tampa, for example, right? Or places like that. I'm looking at places that are like the boring markets, the places like Kansas City, or places like, like North Carolina, which there's almost no city that's popular out there, but, I'm looking at places like that where it's just boring. They don't really appreciate big. They don't depreciate as a result, like they're just kind of steady and they pay good income. They're good, low prices for the income that you get. And again, you don't have to live in those areas. I don't own any property in the state of Utah other than my own house. And even that, I think is too high. So I buy properties out east, and I have somebody else manage them. And that's the key. If you find somebody good, that's the problem. Sometimes people try to manage their own properties. That's another issue too. Also another issue I find, like one of my clients in another one in California, he had a property he had out there that had 700,000 of equity in it. It was his very first starter home. He went and then turned it into a rental later on. So they had it for a couple of decades, 700,000 of equity. He was netting $200 a month.
Wow.
That's it. Now his goal, this is another faulty thing that I find too, is that people think, okay, the goal is if I buy a real estate property is pay off that debt and then I'll be debt free and I'll make all this income. Well, even after he paid it off and made it debt free, he was still only netting like $2,300 a month.
Mm-hmm.
Now, if I told him, I said, listen, his name was Henry. I was like, Henry, that 700,000 of equity that you have in that property, if we sold that property, moved it to other properties where you only made even just a 10%, what they call a cash on cash return, meaning that you net 10%. That's 70,000 a year that you net after paying your taxes and insurance and everything. Mm-hmm. That's $70,000 versus you getting under, like more like 27,000 a year. Right.
Mm-hmm. Right.
And for a while, he's like, I don't know. I was like, this makes sense, and finally after like, it took him about 4 years, he finally just said, you know what, now I see it. I could do much better elsewhere. So now he's like bought a ton of property like Louisiana and down the South Belt area. Mm-hmm. And now he's seeing the bigger picture because now he's gotten that money out and using it. He's seeing that he's making way more profits there than he would ever in California. Right. So again, that's the problem. Like many times people try to do it by themselves, but you don't have to do it by yourself. There are ways to have support and have people that are more experienced to help guide you along that process.
Sure. So getting back to like our audience, if you got someone who's running a business, let's say a photo business or whatever, and then they realize, man, I got to start making plans to set up my retirement. Now, something like this, they would be thinking, well, gosh, I don't want to, I'm not in the real estate business. Why should I be doing this? Where I think your advice would be, you're not in the real estate business, you're in the liquid cash business.
That's right. Exactly. You never want to do any investment that takes your focus off of your biggest golden goose, right, which is your business, right? Your photography business. That thing needs to be protected. Now, at the same time, you don't want to have that be your only thing, right? Because you have another COVID where they say you're non-essential, quote unquote, crap like that, or even though you can get around that stuff and pivot, but still, like you don't want to be in a situation where that is all you rely on. You want to have those diverse streams of income coming in just in case,
right?
Anyways, in the meantime, and then of course down the road when you may want to sell the business,
right?
So you're right. You don't want to do that. That's why when we talk about passive investing, we literally mean it's passive. Like somebody else does the investing or does the work. Mm-hmm. You're merely the one that's using that money to work for you.
Right.
Like for example, going beyond just having rentals, right? Rental, I would say, is like the least passive type of investment I talk about often, but like you can become the bank. I mean, there are people literally out there that will pay you a contractual 10, 11, 12% return on your money each year. They'll even break it up quarterly or sometimes monthly in payments to pay you that on your money. They'll pay you interest only payments on your money. So if you give them $100,000, they pay you 12% a year. That's 1% a month, meaning that 100,000 now is paying you $1,000 a month, not touching the 100,000, right? So your golden goose is still there, it's laying those $1,000 a month golden eggs, but it allows you to actually keep generating income, right? So there are lots of things you can do there, from, like I said, like lending. You could be lending money to those investors where they make the money off it, make way more than what they pay you, which is why they pay you that much. Mm-hmm. There's, other types of investments that might share in profits. I mentioned oil and gas, like that guy had done. I have an investment in that as well. And the nice thing is that we're getting paid rent from the big oil companies, because oil companies actually don't want to own land, believe it or not. They just want to have the business to drill, do what they need to do. They'll just rent and do that for decades if they can do that.
Right.
So they'll pay you for the lease on the land. And then of course they'll share in the profits too. So any of the mineral rights you get, that means not just oil that they pump, but even the natural gas, that's the clean green energy that comes off of it, as almost like steam in a sense.
Right.
That extra gas comes off too. You get paid on all the stuff that they sell off. So it's kind of nice to kind of get that double dip effect, when you do those kind of things. I'm getting paid, over like almost $7,500 a month on raw land, where there's no tenants necessarily. It's just you literally, I have a partner that does all the transactions. I finance it all. But we're taking that money and using that to buy raw land and then turn around and selling it to other people. And they pay us like we're the bank. They pay us like a mortgage of over like next 5 or 10 years or so, and it might be $200 a month. They're paying for that piece of property, whether it's to, run their ATVs, do other recreational type stuff, or just have their own homestead or place to escape in case the government, blows up the world or whatever, like that kind of stuff. There's so many ways you can make money and profit and make
so you're
much
saying you
more.
want to focus on preppers. That's the market.
That's right. Yeah, 2020 was awesome in the raw land business,
the
right?
untapped prepper market is out there, is what you're saying.
Oh, absolutely. I mean, even my wife, she's kind of a homesteader. We have she has 25 chickens here, and we have garden stuff. And even she's like, wait a minute, some of these properties, can we buy these too? And my partners are like, well, yeah, but you're going to pay the retail price. You're not going to get the wholesale like we're buying it for you the other ways. But they're like, yeah, if you want a piece of property, go pick it. Like, she's like, oh, cool. I want a creek running through it or something like that. Lots of trees and, that kind of thing. Right. There's just so many options that are outside the traditional mutual fund stock market box that really is high risk and mediocre returns.
So this sounds like a lot of work, though. This sounds like a second
Sounds
job.
like it, but it is for somebody else, just not you.
Okay. No, I mean even to find partners and find people, to do this. So, that's what I'm saying. It's like, this sounds interesting from, like I said, somebody with more an entrepreneurial bent who understands ROI. They understand, hey, I want my cash to work, because a lot of these folks, again, if you're running a photo store, you know how to manage cash, because it's feast or famine, because it's a very seasonal business. So, and obviously you can't go to the local Edward Jones or Raymond James guy to get help for this. So where do you go?
Well, I mean, not to sound too self-serving, but I mean, that's what we do at Money Ripples, right?
Right.
I mean, it's true. I mean, that's kind of why I came out of retirement to do what I do, because people always ask, well, how do you do it? And I spent years developing those relationships with different, investors that haven't been because there's so many people out there trying to get your money right now in the real estate space.
Sure.
That said, hey, I've been investing since 2017 or 2018. And I've made lots of money in real estate. Well, who didn't? You could have been an idiot and made money in real estate in 2017, 18, and beyond, right? I like the people that actually have been seasoned. Those have been through at least a full market cycle. Like they were investing during the last recession, or maybe even prior to that too, or previous recessions even. Right. So I built kind of my own network of people that I help share with a lot of our VIP type clients, where we help them one-on-one. We even help clients strategize too. Sure. Like, where is that money trapped in prison? How can we get that money out? Like if you have an IRA, could we actually use that IRA money? Most people don't know this. You can actually take the IRA money, not have it in the stock market, but actually invest it in these same deals that I was talking about. So you can actually use IRA money to do that. If you have a Roth IRA, you can invest in some of these deals and then have tax-free income kicking off some really good returns, So we kind of offer some guidance that way with our one-on-one clients to really kind of strategize the game plan, right? Help you figure out what strategy can you do? How can you make the most of your situation? And then of course, connect you with who might be some better options for you in that game. We're not investment advisors. We don't ever give investment advice, but we could say, listen, your goal is, maybe you want this much income per month. Here's some people you should probably look at some of their options. This other one doesn't fit your goals, but some of these other options might do that. Here's the people that I've even invested with or I've known for years. Here's the people you should talk to.
So now most people say you should have your stuff, if you're looking at retirement planning or end of career planning, if you want to call it that, you should have it vary. So you're saying you should have yourself, you shouldn't be in a money market or one of those type of plans at all, and no mutual funds at all. You should have it all in this type of thing. Do you think that's a great idea? I mean, obviously you think it's a great idea, but I mean, shouldn't you be insulated a little bit, even though the returns on some of these may not be great? At least it's, pretty dependable.
I mean, money markets is one thing, because having liquid cash, emergency reserves is definitely a foundational thing that we teach. There are ways to diversify your emergency fund, the money you're keeping on hand to make better returns. Like for example, my wife wants $300,000 that we don't touch. We don't invest. We don't do anything. It's just there for in case the world blows up, whether it's our personal world or the world outside of us. Right. And for that, I mean, I remember she was saying, well, we can keep in the bank 300,000. I said, well, $300,000 at point nothing percent. Even right now it's 0.1% in our credit union. That's not very good. And yeah, we got some online savings accounts, but still you get taxed on that too. So you don't even get that full return. So I actually keep $250,000 of my money in a strategy we call infinite banking, which is actually using life insurance instead, where I make about a 5% tax-free return on that money sitting there. So instead of making, if you do the math, 0.1% on $250,000, for example,
Right.
is $250 a year. And then in the bank, if I were to make that, I got taxed on $250. So maybe I'll walk away with like $150 to $200, right?
Mm-hmm.
But that same 250,000 is making me about 12,500 tax free.
Right.
So now at least if I have that savings, I can do that. I can diversify a little bit more. I can keep some money.
Plus,
safe.
it's cumulative. I mean,
yeah, exactly.
It's compounding as it's
cumulative.
going. Right? Yeah.
Exactly. But you can't just do any method. Like that's the one danger of that, because most insurance agents just do a crappy job. Like they really just pad their own pocketbooks because they just set up these high expensive policies. So when I say that with warning. I do have other stuff on my website and podcast. We talk about how to do it right, but that's an example, right?
Yeah.
Like,
So you're talking about
really
like whole life or something like that, right?
Yeah, it's whole life, but it's whole life that's minimal cost whole life, which is much more rare to find.
Yeah, I was going to say usually whole life is a little bit higher. So
exactly, it's very expensive. Yeah, that's why guys like Dave Ramsey say buy term, invest the difference, because whole life, the traditional form, is so dang expensive.
Right.
I wouldn't buy it either. Right, I would agree with him on that, but there's a way to do it to where it actually makes it better cost than even a term insurance policy too.
Okay.
So could you keep in the stock market though? I mean, I would say this: if you have money you're willing to gamble, great, do that. I have a client right now that she has a bunch of Google and Apple stock, like even individual stock, not even a mutual fund, right? And the thing is, even mutual funds, most of them aren't really diversified anyways. Like when the market tanks, you lose money. Like it's not protected. Same thing with her. So we talked to her about that option. Like, listen, there's a warning here. Although the stocks have surged this year, if you don't pull out those profits at some point, it could also tank again. Right. So, sometimes it's like you could scale out of some of those things. Maybe you still keep some stock, but maybe you take some of those profits now while it's high, use that to invest elsewhere, and then you make a lot more money elsewhere. And then you kind of diversify yourself better. Because the truth is, people in mutual funds, IRAs, 401ks are not diversified at all. Even the S&P 500 that everybody says that's the gold standard you're supposed to meet. Do you know that about a quarter of the S&P 500 is just 7 companies? Actually, it's 6 companies. It's one gets counted twice because they have 2 different stock shares. So it's just 6 companies like NVIDIA, Google, Meta, Apple, those kind of companies, right? Microsoft. Those companies are like swinging the whole pendulum, and they're mostly tech stocks, right? So if tech ever tanks, even though the whole stock market is supposed to be the 500 companies, tech will take it down if tech goes down. So you got to be careful.
Right. Yeah. And when we just saw that recently with, some of the troubles the banks were in, right? Banks are supposed to be, safe investments, and, people were very, confident banks. And all of a sudden, I think I saw a chart somewhere that the amount of losses in the bank sector was almost the same as the crash in 2008 or 9.
Yeah. And it's amazing how quiet they're being about it, isn't it?
Well, yeah, it's crazy how that happened. And yet, no.
It only happened to 3 banks. Like, well, we heard a 4th one in California just happened recently, but like, it's only, right? Like, that's it. No, it's all done. Like, that's bull. We all know we all know they're lying through their teeth when they say that. There's something bigger coming along. Yeah. And that's a big reason why the stock market has boomed so much lately. I was like, this is where all the dumb money, as they call it, like right when there's big booms like this in the market, usually that's where the dumb money, the average investor puts their money in. Right. And that's when the bigger companies, the institutional, what they call institutional money, the big companies will pull their money out quietly without you knowing. Right. And then it tanks. Right. Right. So you got to be careful. You want to be the person that's more like them, where you're like, well, maybe I want to get my money out. I'm not giving investment advice right now, by the way, but I'm just saying you got to be aware. If you got money in the stock market, that to me is more active. An active management, because if you're not watching it all the time, you could lose money in a heartbeat. Right.
Whereas, like you said, with something like this, it's a set it and forget it type.
It's like watching grass grow.
Right.
Yeah. It's more boring.
Oh, yeah, it is boring. Well, you want to have time to go tend to your chickens and stuff. I mean, that's important.
That's right. Yes. Speaking of something that costs more than it makes you, I'll tell you, chickens are definitely one of those investments that, you're only doing it because you're like, if that world ever blows up and we can't have eggs anymore, at least I have eggs.
And, chickens, okay, if you have to resort to eating your egg producing
That's true.
Machinery.
Yeah. Eat our old golden goose.
There you go. There you go. So this is all very interesting, but it sounds like it's more than the scope of our conversation. Where can someone go for more information if they want to learn more about this process?
Yeah, very simple. You can either go to moneyripples.com, which is our website. Got lots of information there. You can also check out our Money Ripples podcast channel on YouTube or iTunes or wherever you get podcasts as well. We've got a lot of things that we teach on there as well, and kind of similar time frame, usually like 20 to 30 minute interviews as well, and just in time for your drive.
Great. Well, thanks, Chris, for your time. Appreciate it. I've learned a lot. It kind of frightened me, but I've learned a lot. And I'll definitely be checking out the podcast and the YouTube channel. So thank you so much.
Thank you.
Thank you for listening to the Dead Pixel Society podcast. Read more great stories and sign up for the newsletter at www.thedeadpixelssociety.com.